Hello and welcome back to Well Balanced, where we talk about the markets, the economy, and what it means for your financial plan. I'm Jason Ranallo from Vector Wealth Management. Let's start with what's been making headlines lately: consumer confidence. The latest report from the University of Michigan showed that U.S. consumer sentiment fell to 50.3 in November, one of the lowest readings we've seen during this economic expansion. It's actually the second lowest level since the pandemic recovery, just above the June 2022 trough. The decline was widespread across age, income, and political groups. Though there was one bright spot, households with larger stock holdings were more optimistic thanks to a strong year in the stock markets. The main drag has been uncertainty, partly from the government shutdown and partly from signs of the labor market cooling. When consumers feel uncertain, they tend to spend less, and that can slow overall economic growth heading into the holidays. Now, the good news is that inflation expectations remain fairly stable. The one-year outlook ticked up slightly, but the 5-year expectation level fell to 3.6%. And just to clarify what inflation expectations really mean, this is how much consumers believe prices will rise in the future. When people expect higher inflation, they often adjust their behavior, asking for higher wages or spending faster before prices go up, which can actually fuel inflation further. Now, seeing these expectations stabilize is a positive sign that inflation pressures may continue to cool, and it gives the Federal Reserve room to keep easing interest rates gradually. When we step back, it's important to remember that economic cycles and market cycles are normal. If we look at long-term data, economic expansions in the US have historically lasted about 4 years, while recessions, on average, just over a year. Contrast that with financial markets, which tend to move in even longer rhythms. Each stock market downturn feels unique, whether it was the 1970s stagflation, the dot-com bust, or the global financial crisis, or even the pandemic crash. Yet every single time, markets eventually recovered, and then some. On average, bear market declines last about 14 months with a 39% drawdown, while bull markets run roughly 70 months and deliver over 220% cumulative returns on average. That's a reminder that staying invested through volatility is critical to capturing long-term growth. So where does this leave us today? Yes, consumer sentiment is low. People are uneasy about inflation, jobs, and government dysfunction. But at the same time, the market has been resilient, supported by solid corporate earnings, moderating inflation, and the early stages of Fed interest rate cuts. Periods like this, when headlines are negative but fundamentals are stabilizing, often set the stage for opportunity. Historically, some of the best 12-month returns in the stock market have come after sentiment troughs, not peaks. That's why at Vector Wealth Management, our approach remains grounded in time-tested principles. First, stay diversified across asset classes, geographies, investment styles, and importantly, time periods, because we can't predict which part of the market will lead in the short term. Second, we use a bucket or goals-based approach, intentionally structuring portfolios so that short-term spending needs are protected from market swings, while other growth buckets are invested for longer time horizons. This way, we believe individuals can weather short-term uncertainty without derailing the long-term goal. The takeaway? Even when confidence is low and headlines sound discouraging, it's often the moment when patient investors are rewarded for sticking to their plan. If you're feeling uneasy or just want to review how your financial buckets are positioned for the next few years, we're here to help. And if you found this conversation helpful, please share this episode of Well Balanced with friends and family who might benefit from this perspective and approach. I'm Jason Ranallo with Vector Wealth Management. Thanks for listening. Remember, stay balanced, stay diversified, and focused on what you can control.
All content discussed in our podcasts, videos, or related blog articles are for informational purposes and should not be construed as individualized financial advice. Opinions expressed herein are solely those of Vector Wealth Management, our staff, and guests. Material presented is believed to be from reliable sources. However, we make no representations as to its accuracy or completeness. All information and ideas should be discussed directly and in detail with your financial advisor prior to implementation of a strategy or investment.